Hello, everyone. Welcome to Property Zone Live again. I'm Sean here, and today topic is about US again. Okay, we just can't run away from the United States, and this is about the interest rate policy they have been implementing, and so many of us are still trying to guess: is it the end of the rate hike? What are the indications you're looking for? So, what I did actually, I have did some. Articles pop up and actually did some presentation slide and I actually want to summarize it again so that everybody have better understanding of what is the interest rate movement now in the state which is affecting everyone, and also what are the things they will look for before they decide to further increase the interest rate, to hold, or perhaps in the later part of the year, is there a possibility for them to reduce? Basically, what are the things to look for? What are the indicators? So without further ado, let me just gonna pull the some slide out and just gonna share with you. Okay. 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 Basically, this is a graph. They say a picture paints 1,000 words, and here you go. This is basically a graph that summarizes the interest rate movement that not just happened back in 2020 COVID time, but all the way back in subprime crisis time, which happened in the year of 2006, 2007. So you look back, it's about 15, 16 years ago. So just a bit of summarize and recap, just in case you are first come to the interest rate cycle of the United States, or you just want to have a quick recap of what was going on for the past 15, 16 years. I think many of us may or may not be aware that now before subprime crisis, there are basically a party time in the US market, especially for housing market. Okay, so interest rate was raised to up to 5.25% at the time to curb basically the party time, the hot money flowing around in the market. So, but during that time, one thing that triggered the housing bubble, which is the subprime crisis, okay, the height of the incidents was marked by Lehman Brothers, the investment bank that went bust. So subsequently, U.S. Federal Reserve, which is Central Bank of U.S., has aggressively reduced their interest rate from 5.25% all the way to 0.25% during this very short span of time in the year of 2008. Okay, but this is a similar incident that happened back in 2019, and we were actually at a downtrend of the interest rate. I'm talking about from a US perspective, okay? And this rate drop, interest rate dropping, was accelerated by the COVID incident, as you can see. So what you can see, the light red color time, you can see it marked by the recession area and also by the aggressive rate drop. Okay, there was a bit of what happened before. Okay, so in other words, during 2009 all the way 2019, right, we see a very stable interest rate and a very gradual interest rate hike from the year of 2016 until 2019. Now, 2021, 2020, 2021 has passed. When we enter the year of 2022, we are basically seeing a very aggressive interest rate hikes, which is normally we look at the Fed fund rate, US Federal Funds target rate. In short, we call Fed fund rate. Okay, so in the year of 2022, okay, all the way until just a week ago, the US Fed fund rate was raised to 4.5 to 4.75% from the low of 0.25%. Wow, I think there are two things we need to look at it is, first of all, this time of interest rate, you can see the slope itself is much greater and much sharper compared to the previous rate hike cycle. You can see this is for 3 years, it has gone up from 0.25 to about 2.5. But since 2022, just a year ago, we can see the rate has gone up from 0.25% all the way to 4.5%. So not only it has a very sharp increased graph, but also at the same time, a very significant momentum. Okay, so this is where we are now as of last week. Okay, now since March 2022, the Fed, which is the Federal Reserve, has actually raised their interest rate 8 times. And out of the 8 times, 4 of it are actually 0.75%. Very, very aggressive rate hike. But in December, if not mistaken, the increase of the rate has reduced to 0.5%, no longer 0.75%. So in other words, market are actually welcoming it. And the latest rate hike just a week ago, they still increased the rate, but the magnitude of it has further reduced to 0.25%, or what we call 25 basis point. Okay, so market are expecting and they are actually hoping that the standing point of Fed will be turning from hawk, very aggressive rate hike, to a dove, very neutral, or even holding the interest rate high. This is what actually the market is expecting. Now, why we need to care so much about the rate hike in the US? Because whether you like it or not, whether you believe it or not, whether you are actually benefiting or you're suffering from it, okay? Rate hike, when I'm talking about Fed fund rate, okay? Fed fund rate, the interest hike will still have a great influence on stock, crypto, and especially if you're listening to this, you're probably actually from the housing market investor as well. Okay. Now next. So as I mentioned to you, whether the Federal Reserve or the Fed in call would increase or put the interest rate on hold, there are basically two major indicators they will look for. Number one is inflation. Is inflation rate hot? Is everything getting more and more expensive compared to same month last year? We're looking at consumer price index based on year to year, okay? And whether the things are becoming more expensive compared to last month, there's a consumer price index. And the other one, they were looking at PPI, which is the producer price index as well, okay? Has the manufacturing cost become more expensive? So these are one indicator. Of course, in general, the higher the inflation rate is, whether it's compared to last month, whether it compares to same month last year, then you will actually hold a very heavy weightage in Fed decision. Okay. Number two will be the job market. Okay. The job market, there will be the US Central Bank will be looking at will be the unemployment rate. Is everybody having a good job? Is everybody's able to find an active income to sustain their living expenses? The other one they will be looking at the non-farm payroll numbers. Okay. In short, inflation is normal. Okay, just like our body temperature. Okay, we must have certain temperature. When you touch our own body, you feel warm. Okay, there is a standard of it. Yet, you can see here, a longer and higher than the normal type of inflation. For example, hyperinflation is very bad for the economy and market. Just like when you actually have a normal, higher than the usual, higher than the normal body temperature, it may damage your other organs. So aggressive move, aggressive cure may be taken, step may be taken to address the issue. So in this case, so hyperinflation is like a feverish disease. Your body temperature is higher. Just like when you see in a market when inflation is running high, hot money is everywhere. Things are getting more and more expensive, not just by years, sometimes by months or even weeks. Okay, you will see, okay, the same plate of noodles is getting more expensive just compared to last month. And price of the same products has gone up 3 times in half a year. These are some of the indication of inflation is running red hot and inflation is running on the high side. So when you have situation like this, just like body is having a feverish disease, the doctor, the financial doctor, the ultimate central bank of the US has to raise the interest rate, use it as a medicine to cool the market down, just like a medicine to cool the whole body down. However, just as everybody know, sometimes when we take medicine to fight against a very aggressive disease, it comes with some side effects. So in this case, an aggressive interest rate hike is like a very potent and very powerful medicine. It will have its own side effects on the economy and market. And what are the two? Number one, you will see when Federal Reserve or central bank in any countries, okay, for that matters, increase the interest rate, the cost of running a business will actually goes up. Workers will have to demand higher wages because things are getting more expensive. They will tell you, boss, no, you can no longer pay us 2,000 because everything are getting more expensive by 30%. We need at least 2,005, for example. So the cost of the business has gone up. Number two, interest rate has gone up. It means the financing cost of the corporation, financing cost of the business has gone up. If they have taken a loan from the bank to finance for their factory, to finance for their other business expenditure, it has gone up as well because the interest rate installment has gone up. So with this case, if they cannot pass down the cost to the market, okay, the earning of this corporation, business entity, their earning will drop because their cost has gone up. Okay. The second side effect of an aggressive rate hike, just like what happened in 2022, will be the unemployment rate has gone up. Okay. Now, whether this is the direct side effects derived from the 2022 aggressive rate hike, let's have a look. Okay, just 2 days ago, okay, on the 7th of February, the Federal Reserve Chairman, Jerome Powell, actually says inflation is starting to ease. Okay, this actually have brought a huge relief to the market, saying that inflation is starting to ease. So the underlining meaning is like rate hike is gonna be on hold, or the magnitude of it will be reduced. But at the same time, it also says interest rate is still likely to rise. So the market was digesting this kind of contradictory statement from the Federal Reserve Chairman. They really want to digest and see through the true meaning of the statement issued by the chairman. So in short, word by word, what he said, if you continue to get, okay, for example, a very strong labor market report or higher inflation reports, okay, if it does goes hand in hand, that means that the disease require a stronger medicine, but I don't see a side effect of it. So it may well be the case that we will have to do more and raise risk more than its pricing. How strong the labor market? Ultimately, everybody was hoping that the labor market would not be as good, because a good labor market will give Federal Reserve, the central bank, more rooms, more power to increase interest rate. But just on the contradictory, right? Even after raising the rate for such an aggressive move, they actually put in more jobs than expected. They actually put in 517,000 jobs in January. Okay, so in short, unemployment rate had hit 53 years low. Can you imagine that? So it means that everybody can find a job even during the corporate earning dropping time. Okay. So in summary, lowest unemployment rate in 53 years, give the Fed, the Federal Reserve, the room and flexibility to raise their interest rate further if necessary. Just like if I give you the medicine, I don't see the side effects. That means that I feel confident to give you the medicine. Yet, easing inflation data convince the Fed that the move is not necessary as of now. So it means that, but I don't see the need. Okay, if your body temperature has started to subside, okay, it's longer on a high temperature one, perhaps the need to increase the interest rate is not there as of now. Okay, so that's basically the two things we need to look at why job market report data numbers is also as important as inflation numbers, for example CPI, for example PPI, to determine whether the Fed is going to further increase the interest rate or it has come to an end. Okay, so if you are an avid property investor and you feel that eventually interest rate will have very great impact on the property market movement, not just in the state, not just in the world, but particularly in Malaysia, and you want to find out not just the history, but in future, when they're going to announce the rate decisions, you can actually, maybe you can snapshot here. Okay, we have passed the January, February. Okay, perhaps the next one we are looking at would be 23rd to 22nd on the March. Okay, almost the last week of March. 8 times in a year they will hold decision. Okay, and the next one is going to be end of March. Okay, so for this is my sharing for today, understanding whether US interest rate hike has come to a pause, come to a halt. What are the indications, which is the unemployment data and also the inflation number. So with this, thank you for your time. I wish you a very good Thursday evening. Okay, goodbye and good night.